Hi there, it's Justin Lubino with Senior Advisors. It's March of 2024, and this time of year, we seem to get a lot of questions related to HSAs and Medicare and how these things coordinate. It's tax season, so I'm guessing that's what's triggering a lot of these questions. We actually teach a 1-hour continuing education course for insurance professionals on this topic, so we get pretty deep into it. But for this video, I just wanted to try and create a little bit of a shorter video to touch on some of these key questions that we get related to Medicare and group health plans and HSAs. If you do like these videos, please like them, follow us, subscribe to us, put your comments below. That allows more folks to actually see these videos and get the good content and value out of them. So I appreciate that. So what we're going to cover, before we jump in, I do have to mention the disclaimer that what we're going through here should not be really used for tax or legal advice. You want to talk to your professionals, your CPAs and lawyers and so forth if you're looking for tax or legal advice. So there's the disclaimer. Now let's jump into the contents of this presentation. We're going to go through questions we get related to folks that are still working past the age of 65. So we're going to touch on that, some enrollment scenarios for Medicare, and then we're going to jump into, the questions we're getting a lot right now, which are related to HSAs and Medicare. I'm going to give you a little bit of background on what an HSA is, and then we'll talk about eligibility and some scenarios or examples for HSA contributions. Okay, we have full videos out there that go deeper into Medicare and how you make a decision versus a Medicare supplement versus an Advantage plan and Part D prescription coverage and so forth. That is not the purpose of this video. Again, this is specific to those group health plans and Medicare and HSAs and how those things all interact. So one of the most common questions we get from folks is, I'm turning 65 next month, I'm still working, but all my friends tell me I have to sign up for Medicare or I'm going to be penalized. What should I do? Well, to answer this question, we have to discuss these federal rules. They're called the Medicare Secondary Payer Rules, which determine which insurance is going to pay your claims first. So if you're working past the age of 65 and the company is a small company, if it's less than 20 employees, then Medicare is going to be primary payer of your claims. What does that mean? It means, yes, in that scenario, you would have to sign up for Medicare because it's going to, if you don't have Medicare in place and you stay on the group plan doesn't have to pay for 80% of your claims because Medicare is supposed to be there. So in that case, yes, you have to have Part A and Part B of Medicare. However, if you're working at a larger company with 20 or more employees, or your spouse is working at that large company and they're covering you, in that scenario, the group health plan will continue to be the primary payer of your claims. So what does that mean? It means you can stay on that group health plan. You don't have to do anything with Medicare as long as you're actively employed or your spouse is actively employed at that company and you're covered on that plan. It's going to continue to pay your claims. You shouldn't have any issues. It's optional in that scenario. If you want to do a comparison, which we can help with, to see if it makes sense to come off of the group health plan and get Medicare, if you can get it for lower cost, better coverage, that's up to you. You've paid into Medicare your whole life, so you certainly have that option, but you don't have to. You could stay on that group health plan as long as you continue to work. These rules are slightly different if you're on Medicare due to disability. In that scenario, the company size that the government's looking at is less than 100 employees, where Medicare is primary, and 100 or more where the group health plan would be primary. If you're on a retiree health plan, Medicare will be primary. So that means at 65, you would have to sign up for your Part A and B, and the retiree plan would essentially be secondary to Medicare. The last row here can be a little confusing if you're on COBRA benefits. So if you're working at a large company, this 20 or more employees, and you're actively employed, remember the group health plan will continue to be primary payer for your claims, so you could stay covered on that group health plan. But when you leave active employment, let's say you're 67 years old, and by federal law, the company has to send you this COBRA offer, which is basically the same health insurance you currently have, but you pay the full premium for it. And in that scenario, if you take the COBRA, it becomes secondary to Medicare. Very important there. So in that case, you would have to sign up for Medicare A and B, and COBRA would be like a secondary payer to your Medicare. In most cases, it's not going to make any sense when you look at what you have to pay for COBRA in that scenario, because it's secondary to Medicare. You're better off generally getting a supplement and a prescription plan, for example. So, but that's a little confusing because it feels like the same insurance card as what you've had on the employer plan. But once you leave active employment, you have to get your A and B in place. And if you do decide to take COBRA, again, it would be a secondary payer. If you don't sign up for Medicare, the COBRA insurance wouldn't have to pay for 80% of your claims. So these are this Medicare secondary payer rules. Again, this determines the answer to that question. I'm turning 65 and I'm still working. Do I have to sign up for Medicare or not? So another frequently asked question we get, I'm turning 65 next year. All of my friends tell me I'm going to be automatically enrolled in Medicare when I turn 65. Is this true? So it really depends. So if you're already taking Social Security benefits, you will be automatically enrolled in Medicare Parts A and Part B. And the government's just going to mail you your Medicare card about 3 months before your 65th birthday. The effective dates are going to be the first of the month you turn 65, but the government will automatically enroll you only if you're taking Social Security prior to turning 65. And it's at least 6 months before you turn 65 that you're taking Social Security. If you're turning 65 and you're not enrolled in Social Security benefits yet, and you want to enroll in Medicare, you can do it directly on the Social Security website. It takes about 5 or 10 minutes to do that. And there's the link on the screen there. And if you're enrolling after age 65 in Medicare, you have, when you leave active employment, you technically get it's called an 8-month special enrollment period, or SEP, for Part B of Medicare, and you get a 63-day special enrollment period for Part D, as in drugs. Now, how do you enroll if you're enrolling after age 65? You can't just do it online, because you have to prove to the government you were covered on that employer health plan since you were 65, so you don't have any penalties or delays. So these are the two forms you would use to do that. There's the enrollment in Part B form, which you fill out and sign. And in the remarks section, you put your requested effective date for the Part B to start. And then the second form gets filled out by the employer, the request for employment information, and it just has some key dates of your employment and your coverage with the employer plan. Again, that's how you avoid any penalties or delays if you're enrolling after age 65. Okay, so now we get into the tax-related question that we get. It's really HSAs. And, I'm currently covering this is an example, right? I'm currently covering my husband on my employer plan, and we have an HSA. I am 63, but my husband is turning 65 next month. Can we continue to contribute to the HSA? So we're going to get into the answers for these and many other HSA scenarios later on. But before I do that, I wanted to just explain to folks, if you're not familiar with an HSA, I'm going to explain just a little bit of background on the HSAs, and then we'll get to some of these answers on these HSA questions. If you already know what an HSA is, you can skip ahead to the scenarios later in the presentation. So what is an HSA? Well, there was a bill passed in 2003, the Medicare Prescription Drug Improvement and Modernization Act of 2003, and they added this Section 223 to the Internal Revenue Code, which basically allows individuals to create these health savings accounts beginning in the year 2004. What is it? It's basically a bank account. So you create a bank account in your name. It's the only type of account that is we'll call it a triple tax advantaged account. What does that mean? It means the money that you put in to the HSA is tax deductible. The money can grow with no taxes on the growth of the account. And then also, when you take the money out, as long as you used it for qualified expenses, which we'll get into, there's no tax you pay at that point. So you don't pay tax when the money goes in, you don't pay tax on the growth, and you don't pay tax when you actually use the dollars. There's no other account like that when it comes to taxes. So it's a great benefit. If you have it available to you, you could take advantage of it to get the triple tax advantage. There are some requirements, however, related to these HSAs as far as whether or not you can contribute to an HSA. So the first, you have to be covered on what's called a high deductible health plan in order to contribute to an HSA. So the deductibles, these change each year. The government sets the level of the minimum deductible in order to be a high deductible health plan. But when you enroll in that health plan, it will tell you whether it's HSA eligible or not. You may not be covered under any health plan that would disqualify you from having an HSA. So you can't have another plan with your spouse, for example, that would disqualify you and still contribute to an HSA. And then this is the one we're going to spend the most time on. You must not be enrolled in Medicare. Okay, so you cannot be enrolled in Medicare and still contribute to an HSA. All right, so we're going to focus on that one in a minute. So what are those contribution limits? If you're eligible to contribute to an HSA, and this is for 2024, if you're watching this video in future years, these scenarios we're going to go through, you're just going to update the numbers for the maximum amounts for the given year. But these are important because these limits will come into play when we look at prorated amounts for Medicare folks and how much they can contribute in the future. But $4,150 is the maximum individual contribution limit for 2024. If you have a family health plan with an HSA, the maximum you can contribute is $8,300. And then if you're over 55 or older, you can contribute an extra $1,000 into your HSA. If you contribute more than you're allowed to contribute, you're generally responsible for a 6% excise tax. If the IRS catches this in an audit, that's what the penalty would be, in addition to the income tax on the excess contribution. So, again, the purposes of the HSA is you're getting to deduct that amount from your tax return. So if you're contributing more than you're supposed to, anything you contribute above that would be eligible for the income tax that you're supposed to have paid, plus another 6% penalty or excise tax. You can avoid this if you identify that you've over-contributed and you withdraw those funds and any interest or gains. You will have to pay income taxes on those withdrawals, but that's how you can avoid that penalty if you identify you contributed too much. What can I use my HSA dollars for? So once you have money in this HSA account, if you're going to spend that money, you have to use it towards qualified medical expenses. It can be for the account holder, the spouse, and dependents as well. It includes medical, dental, vision, and other out-of-pocket expenses. It also now includes over-the-counter medications. And you can also use it for premiums for health insurance, for COBRA, long-term care, and Medicare premiums if you have Part A premiums, B, C, even D. You cannot use it for Medigap or Medicare supplement premiums. All right, now we're going to jump into those scenarios. So we have 5 scenarios we're going to walk through. 2 for an individual employee who's turning 65, 1 for an individual who's turning 70 and they're enrolling in Social Security benefits. And then we're going to go through 2 scenarios with an employee and a spouse. If you see EE, it's employee. You're going to see that on multiple slides. So the first scenario here, we have someone who's turning 65 and there's no excess contribution for this example. On the top right of each of these slides, you're going to see the limits again that we saw on the prior slide, just to kind of keep it there fresh for us. This is a person whose birthday is coming up in September, their 65th birthday. In this example, they have an HSA plan at work, and the employer is giving them a $1,500 contribution into the HSA, a nice generous a benefit for this employee. And in addition to that, the employee is contributing $200 a month into their HSA to get that tax advantage. And they're planning to retire in September. So they're going to be eligible for Medicare the first of the month they turn 65. So they're going to retire, go on Medicare, and stop contributing to their HSA. That's the individual's plan. And let's see how this plays out. So the actual contribution, again, the employer contribute the $1,500, and the employee has 8 months of contributing that $200 per month. So that's a total of $3,100 that this employee contributed into their HSA. What's the maximum they're allowed to contribute? So this is where we start looking at the prorated amount for the year. So it's not about when you make the contributions, it's about the total amount that's contributed for that calendar year. And this example, they have the $4,150 individual maximum, plus they can do the $1,000 catch-up because they're 55 and over 55. So we take that total $5,150, we divide that by 12 months, and then we multiply that amount times 8, because they had 8 months of eligibility to contribute before they went on the Medicare starting in September. and that comes out to $34.33 is the maximum they're allowed to contribute. So what's the excess? There is no excess. They're under the maximum amount. All good. And they technically could have contributed an extra $300, $333 to their HSA. All right. So that's the first example. Second scenario. Again, someone's turning 65, and this is going to be an excess contribution scenario. So again, the employer contributes the $1,500 into the HSA. The employee is now, instead of the $200 a month, they decided to do $300 per month into their HSA. And they're planning to retire again September 1st and go on Medicare and stop contributing to their HSA. Now, I did this intentionally to give you another wild card with Medicare, but if your birthday was the first of the month, you actually get the month prior for your Medicare to start. So even though this person was born in October, because they were born October 1st, their Medicare is starting September 1st. So just another curveball that Medicare throws at us. But everything else is similar to the prior example. Now, here's where that actual contribution, right? The $1,500 from the employer plus 8 months of the $300 a month from the employee comes out to that $3,900 contribution. What's the max contribution they should be allowed? It's $34.33. We just looked at that on the prior slide. Same calculation here, 8 months of the year. That's the most this person should be contributing. So what is the excess amount they've contributed? In this case, $467, which would be eligible for that income tax as well as the 6% excise tax if they're audited by the IRS. Again, if they catch this, they can withdraw that money and just pay the taxes on it. So they won't have that, that audit potential with the income tax and penalty. All right, third scenario. This is a single individual turning 70, and they started to take Social Security. So birth date is September, and the employer contributes the $1,500. This employee is contributing $200 per month into their HSA. And here's what's happening. They're planning to retire in September, go on Medicare, stop contributing to HSA. And they're also, going to start to take their Social Security at this time because they're turning 70. And regardless, by the way, whether you take the Social Security or not, when this employee enrolls in the Medicare, Part A is going to get backdated 6 months. Okay, this is one of those other weird rules with Medicare. They're going to backdate your Part A. So in this example, let's say Part A would be, March 1st. So that affects how much you can contribute into your HSA. And if the employer contributes the $1,500, this employee does the $200 a month, that comes out to $3,100 that they've contributed into their HSA. What's the maximum they were allowed to contribute? Well, you take the $4,150 for the year plus the $1,000 catch-up, you divide that by 12 months, but how many were actually eligible? There was only 2 eligible months because the Part A is starting 3/1 of 24. Okay, so they technically were only allowed to contribute $858 to their HSA. So it's a pretty big excess contribution in this case of $22.42. All right. So again, if they identify this, they can withdraw that money, so they don't have to pay that penalty and income tax in the future. That's what they should do if they identify this problem. So, all right, just 2 more scenarios. Now we've got husband and wife or employee and spouse. And in this scenario, the spouse is turning 65 and there's a younger employee. So the spouse's birthday is coming up in October to turn 65, and the employee is a few years younger, not going to be 65 yet. So the employer does the $1,500 into the HSA. The employee puts $500 per month into the HSA. In addition to that, the spouse has a separate HSA, which is perfectly acceptable, where they put the $1,000 into their HSA because they have that. They also can contribute that $1,000 catch-up because they're past age 55. Now, the employee is continuing to work, continuing to stay on the family coverage, and the spouse enrolls in Medicare Part A for September 1st, 24. And the employee continues the HSA contributions for the entire year. All right, so let's look at what happens here. In this example, the actual contributions, the $1,500 from the employee plus the 12 months times the $500 a month that the employee is contributing is the $7,500, and the spouse is also contributing $1,000 into their separate HSA. So that's where you get the $8,500 that they've contributed in total. And you have to now look at the maximum contribution for each of them, because they are, they have different dates for their Medicare, and the employee is younger, right? So they don't have Medicare happening at all this year. And so their maximum amount is the full family contribution of $8,300 plus the $1,000 catch-up. So technically the employee can contribute up to $9,300 into their HSA. However, the spouse is prorated because the spouse only has 8 months of the year where they can contribute to that $1,000, catch-up. So they really should have only contributed $667, or 2/3 of that $1,000. All right. So the total that they could have contributed if they did this correctly would have been almost $10,000, or $99.67 if they split it up correctly. Now, there's technically no excess contribution for the employee because they contributed $7,500 and they had a $9,300 cap. But the spouse technically over contributed by $333 in this example. So the spouse can take that, again, if they identify this, the spouse can take that money out, and the employee can actually add that money to their HSA because they would still be under the limit for the year. So you really have to look at this, even though in total they contributed under the maximum contribution, they each have their own HSA bank account, and they have to look at this from an individual perspective. So last scenario, employee and spouse, where the employee is turning 65 and they have a younger spouse. So let's say the employee's date of birth, again, is October 1st, 59, and the spouse is younger by a few years. The employer contributes $1,500 at the beginning of the year into the HSA. Spouse puts $500 per month into the HSA, and the spouse also puts $1,000 a month into the HSA, that $1,000 catch-up. In this case, the employee continues to work, keeps family coverage. The employee enrolls in Medicare Part A for September 1st, and the spouse continues the HSA contributions the entire year. So what happens here? Well, the actual contributions here for the employee was the $1,500 that came in from the employer, and then the spouse contributed the $500 per month plus the $1,000 catch-up. So that's the $7,000 there for the total of $8,500. But what's the maximum allowed? So for the employee in this example, they're only able to contribute the $1,000 catch-up, but it's prorated times the 8 months, which gets to that $667. And the spouse, even though the spouse isn't the employee, the spouse can do the full family contribution amount plus the $1,000 catch-up, which actually there's a typo there. It should be $9,300. The total is correct of $99.67 that they could contribute technically. But the excess contribution, because the employer contributed that $1,500 into the employee's HSA, and the employee was only eligible to contribute the $667, the excess contribution in that case would be the $833. So again, that money could be taken out of the employee's HSA and put into the spouse's, because there was still some room available there under the spouse's cap for the year. So I know there's a lot of different scenarios here, but we tried to cover some of the different nuances of situations that could occur. And hopefully that helps answer some questions out there. If you have additional questions, our phone number and contact information will be below this video, and you can feel free to reach out to us with any further questions. Hope that was helpful. Again, please like the video, share the video, put your comments in there so other folks will get to see the video and hopefully help them as well. So hopefully you have a great rest of your day. Take care.